understanding the downside is just as important as looking at the rose-colored glasses upside, right? We just looked at a deal that was a disaster, and then it could be the best deal I've seen in a long time, but the potential upside was far and away outweighed. I mean, not, the downside was significantly more outweighed, that the amount of disaster that could go wrong outweighed the potential of it being the best deal ever. And the risk wasn't worth the reward. And understanding that if that downside does take place, what's your fail-safe?
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grenzig.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grenzig. With me, as always, is John Cohen. How's it going, bud?
We're doing good. We got no complaints. We are in March, which is crazy. Actually, maybe this airs, it'll be April, but
no, it's not March yet.
It's March. Yeah, it's nuts, man. It's flying. It's crazy, but we are wrapping up the first quarter of 2021.
Yes. Quick update. How's the quarterly goal going?
We're good. We have surpassed the second quarter goal. So we are down 20 pounds.
God damn.
Which is nice. We had a bender this weekend, which I just got on scale this morning, and I was like, ugh, let's get back. Let's get our shit together. But overall good. It was the goal. Yes, obviously there's a number value behind it, but it was really just to get healthier, more active. And that was really the why behind the goal, which is the important part. If I hit the number goal, I'll be happy as a pig in shit. But I'm waking up feeling so much better about myself. I can tie my shoes without getting out of breath. So that's a big win for me.
That's always a good thing.
Yeah, no, it was an overall get your shit together goal with, the numbers were there as like my motivation to hit them, but behind it was what was more important to just, be healthier, be better, and stay active.
Yeah, no, I hear you. No, that's good stuff. Did you do anything, like, are you, instead of looking at weight, are you like hitting other metrics that are doing that? Like, are you saying like, I'm going to work out once a day or every other day, or, eat 6 out of 7 days? Like how are you doing
So the big things for me is making sure I get at least 5 workouts in a week, cardio workouts. So not, your push-ups and your stuff like that, and not weight training yet. That's my goal was to incorporate that later into the year. The one that I set out for was, making sure you log your meals, because then you could keep a better idea of what's working. You'll look back and you say, okay, now I know why I was up a pound last week. So logging your meals, making sure I get at least 5 cardios in. Each 5, those 5 cardios are at least 45 minutes, which I hit. I've basically hit that every day, every day in January. February, there was a little bit of a lull, but I had a minor problem that prevented me from working out a little bit. So I had like 10 days of where I missed, but that's not the end of the world. I ate much better during that period because I knew I couldn't work out. Logging your full food, making sure you hit the cardio, and then making sure I'm active. Like I'm not sitting down 12 hours a day, right? So, making sure that I stand up, get up, walk around, like, take your breaks every couple hours, walk around 10 minutes, 15 minutes, play with my daughter, stuff like that. I wanted to incorporate that throughout the day. And then the big one, which was a new goal that was implemented later in February, was shutting down. If I was leaving my office at 5, start winding down at a certain time, get everything you have to get done, and then turn it off, right? Whether it's 5, 6, or whatever it is, make sure that you get everything you have to get done, turning it off, keeping the computer closed, and enjoying time with my family and doing stuff that wasn't work related. That was a big one that I just started doing. That's at least once a work week. Like at least one day during the week, shut down early, and early could be, 6 o'clock, just close it. No work for the rest of that night. So don't bring the computer to bed, stuff like that. Those are the big milestones behind the 10 pounds a quarter goal. Because the 10 pound a quarter goal was, like I said, it was the big goal. But what I saw happen was, 10 pounds in January quickly. Then, 10 pounds came off quickly, down 20 pounds. I'm like, oh, yeah, there's some Dunkin' Donuts. Let's have a donut. Oh, let's have a piece of cake. So it was I had to go back and say, okay, what's behind this goal? Because that cake is, I don't need a piece of cake every single day, right? Once a week. Mm-hmm. So that's the high level.
Yeah, no, for sure. I think it's been, interesting for me as well. It's like trying to figure out the stuff behind the other things, with the eating, the working out. And it's like, if you can solve the reasons behind it or the motivation behind it, that's really what changes the results. And I'm sure, that's going to carry over into other things as well. So that's why, doing the 75 hard challenge, I thought was going to be interesting. So
yeah, I've actually used your posts as motivating factors of, okay, I think it was last year. I said, I'm going to do 75 hard. I'm not this year, but I will do it. Mm-hmm. And that's when it was like, okay, so I think, today's February 28th or 3rd, whatever, 23rd when we're recording this. I think I've missed like 14 days total of workouts this mm-hmm. year. So like, that's not bad, 45 out of 60 days. But when I first started, it was 30 minutes a day. Then I saw you starting to do the challenge, and I said, okay, I'm doing 45 minimum. So like seeing your post, I was like, okay, let's do it. Right. There's more competition for myself. So for sure, seeing that, and I've been watching your post, and it's, it's motivating factor. Even, the run you did right this morning, I went out for a run. I was like, all right, make sure you get under your per mile goal. I ran 2.5 miles, and then I did some more cardio on the bike, but I saw that your mile per minute, you played soccer, so you had an advantage, and I'm a fat pig. So I had no shot at doing that, but I said, that's a goal, right? Let's get back down to when you were able to run a 7-minute mile. Like, you can knock that out. Now 7 minutes and you find me passed out in the snow somewhere that, someone would have to come find me. But seeing that, seeing other people's progression and what they're doing, it's the athletic competition coming out, right? It's like, okay, he's doing it, I got to do it now, right? Or he's doing it, how can I tailor it to get to that point? Because it's something I want to do, but I was so out of shape. If I started it, it wouldn't have worked. So I knew that let's get into it, and then once you hit that period of time where you feel good, knock it out. So, I've been doing 75 soft, let's call it, right? Just a little tweak here and there. I'm incorporating.
It's funny you said that, because people have asked like, oh, when you do it, are you going to continue? I'm like, I don't know. I'm definitely going to take a break, like at least a week. And then I've been thinking in my head, I was like, I would love to continue, but I don't want to not drink for another 75 days. And I don't want to like be crazy restrictive on the eating either. Like, I would like to have like, okay, like once a week, like go to a nice steakhouse and not have to worry about like them cooking with a shit ton of butter, and maybe, being okay with having some mashed potatoes and stuff, or, once in a while having some ice cream or something. So like in my head, I'm thinking like, okay, maybe I'll do like a 75 soft is what I've been calling it like the last week of my head. So it's just funny to hear you say that. But yeah, it was the same thing. I just really coincidentally, and I think it's been super helpful, is Chris Turcotte, who I connected with on Instagram a while back. And we've talked here and there, and he's actually been helping me because he runs a property management, big company, property management and mortgage broker up in Canada out of Vancouver. And he started doing it coincidentally the exact same day as me. So it's been like really cool, like every step of the way, like, seeing him do it, me doing it, and being like, okay, like I know he's not going to mess up. He is not failing. Like, he is just not going to mess it up. So for me, it's like, okay, I'm not failing either. Like, because if he's not going to do it, I'm not going to do it. And I know he's probably saying the same thing too, saying like, all right, I know we're both Chris, but I know Chris isn't going to fail, so I'm not either. So having that there has been super helpful. But also then, Mike Taravella is a few days ahead of me doing it as well. And then Austin Linney is on like day like 130 or something like that. He did it and then just kept right into doing it again. So it's like just seeing other people around you doing something similar or the exact same thing is, super empowering. So, I think I'd heard about it, thought about doing it, but then when I found, Mike was doing it, Austin was doing it, I was like, all right, I've got other people that are doing it. Like, it's going to just help me stay on track and push me and empower me. Cause there's been a couple days and weeks where I'm like, fuck this. Like, I don't even want to just like, I just want to just chill in bed or just chill on the couch all day. And then I'm like, all right, I've got to at least go for an hour and a half, which in the grand scheme of things isn't that big of a deal. Cause you can just do like a 45-minute walk and like, you could do two of those, or it's, it doesn't have to be super strenuous. So it's been good. It's been interesting.
That's something, I think that's like a quasi accountability group, right? Which is something that I'll probably I'm vetting some groups right now that I want to be a part of, because one, the competitive spirit's there, right? Knowing someone else completed their test today and you didn't sucks. So it's something that I think is important. Like you said, those 4 people, you guys are policing yourselves, which is the purpose of the accountability group. That's why it's there, or whether it's created physically or not, but someone posts it and shares it and you're like, okay, I got to keep pace, because who likes to lose, right? No one likes to lose or be the one that didn't do it. So that's important. And it's something that, I think they're popping up. I was asked by, a buddy of ours, John Geldert, asked me, how do you find an accountability group or a mastermind? I said, create one. Start one and tell people you want to create one, and see who wants to buy in and put systems in place, right? Say, okay, we're going to meet once a week, and we're going to meet once a month, and this is what we're going to talk about, and be the creator, right? Or like you guys start on the same day coincidentally, but if you can't find one, create one and bring the people in that you want to be in there, and that can push you to, keep going forward.
100%. Could talk about that for a whole episode, but we did want to do this as an episode just talking about 2 deals, kind of do it as like a deal review type thing, which I think a lot of people will find interest in. You guys just went full cycle on a deal that you owned for 4 years, 3.5
4 years, about 4.5 years.
4.5 years. Jeez,
4 years.
Time. 4.5 years, which I think will be interesting for a lot of people. Bigger deal, going full cycle, lessons learned. And then, we just bought a deal, 24 unit that had a, super short timeline. And I think it'll be interesting, for us to talk about, because we, at one time, just as things were going crazy and I was trying to scramble to get the money together, we were talking the deal, potentially partnering, but was able to figure out another way to get it done. So I think talking about some of the things we had talked about and the reasons I ended up doing it will be interesting for people too, because it wasn't a traditional, hey, this is a 6 cap deal. There's a lot of other reasons that went into it. So I think a lot of people will get some value out of it, pick up a couple things, or at least have things to ask questions about or talk about with other people. So wanted to hop on and do that.
Yeah, no, I like that. I think, these intermittent deal reviews, right? So people understand, right? The deal we're talking about was not successful.
Mm-hmm.
We didn't lose money. We did distributions, but the deal is not successful by any measure, any state of the imagination. And, Chris had asked me before, you want to talk about it? I said, absolutely. Because, we've done a lot of deals, and this one was tough. I mean, it was tough from day one, on takeover, the wheels came off the bus, and, it was a lot was out of our control, and a lot was in our control, and we missed, but we made that mistake. We haven't made it again. But I think people need to hear these stories, right? Chris's deal that he's going to talk about, I know it was like a 2-week turnaround to close on a very not down the fairway, maybe down the fairway operationally and economically, but it was not your prototypical garden style community on its own property. There were some challenges with it. So getting comfortable with that. And our deal, we went A to Z, we battled day in, day out, month in, month out. It seemed to never right the ship. And we sold at a period of time where prices were crazy. We had a shitty loan. So it restricted what we can do, but we will get into it and we'll see where we go.
Yeah. No, I think, I'm sure now you would find it super interesting to like go back and be like, okay, what was I thinking at the time and how wrong was I? And I think selfishly, I'm curious to rewatch this or re-listen to it in, 18 months, 36 months, several years, and just kind of come back and see, what mistakes I'm going to make or things I assume that are going to be incorrect, or, maybe even to the upside, right? Maybe I was, way off on, what I thought rents could be, or what I thought the expenses would be, or, who the hell knows? So I think it'll be interesting to hear from that regard too in the future. But let's start with, your deal as best as you can without, your current knowledge tainting it. What was what attracted you to the deal? Why did you guys want to buy it? What was like the reasoning behind it early on, and just some of the, the high level information on the property as well too?
Yeah. So I would say it was 240 units in Greenville, South Carolina. That's the property, the location, the market was fantastic. It was 2016. We already owned a 200 unit in the market that was wildly successful from day one. It was a great cash flow. The one thing, hindsight looking back, we were in a 1031. So pricing probably was a little bit more than I would have liked at the time. I've downloaded on this with one of the investors in the deal. We were talking about what we've done well and what we've done poor. And he said, what was the most you've ever paid per door for a property? And it was this particular property at the time. And to this date, it still is the most expensive per door property we've ever bought. And our deals that have been successful have been the 30 doors, 20 doors, 40 doors, even 50 doors. This property was purchased in the 90s or high 80s. And we were in a 1031, so we were comfortable with it. At the time, it was well below replacement cost. It was in a super strong market. And we were very excited about it. In a market we owned in, we were trying to scale there. It was in South Carolina, so it was a state we were very familiar with and have executed really well in. It was a market that we've executed in really well. And this was a step up in product. So we were historically 70s C-class. This probably still is the nicest sub-market we've ever owned in. This is a property that I would probably live at. This is a property that if I picked you up, blindfolded you, and dropped, you'd be excited that you own the property. It wouldn't be like some of the property we've owned where it's like, maybe not for me. I don't know about this. This is a little tougher. So looking at all of that, I recall, doing our due diligence. We're walking it with just, what are we missing here? Why? Like it just, everything checked off every single box as we got deeper and deeper and deeper into the deal. Our property manager at the time, before we fired them, actually said, in the last 20 years, this is the nicest property we've done due diligence on. This is the nicest, this is one of the best properties that we feel good about this opportunity. So, we sat there like, what can go wrong?
In hindsight, not to cut you off, should that have been a red flag that, hey, we've never, if they're saying, hey, this is the nicest one we've ever done due diligence on, should that have been a red flag? Like, hey, maybe these guys, don't know what they don't know and don't really know what they should be looking for. And they kind of have the blinders on of like, hey, that, because this was, I was going to, say as well on the pricing, this was built in the mid 90s. So in theory, it should be the most expensive. Yes. But looking back, is that a red flag that you should have picked up on? Or was it just, a throwaway comment that wasn't super important?
So definitely not a red flag, because the management company they own and manage, they are builders, and they build their own properties. So they build their own properties, manage their own properties, and third party manage as well. So when they say it's the nicest property, they build their own properties. So you say, okay, well, this is nicer. Now I'm not saying structurally it was nicer than what they build, but from a management perspective, criminal checks, background checks, income in the area, traffic count on a main road right off the side, retail, proximity to job growth. They felt super strong about it. This individual at the management company, and by the way, we fired them on this property after their own admission of, it's not working. We can't figure it out. They still manage a property for us. That's one of our best performing properties to date. So it's not like there's ill will there. The individual at the company. So this is the starting of what probably were the first signs of potential issues. One, the individual that we worked with at the company to buy the other property was leaving, and she was going out to be a CEO of another company. So that was like the week of closing. She introduced us to her counterpart at the company. He was the most negative individual. And she said, listen, we're polar opposites. I think it's great. He always thinks it's bad. This is where you say, wait a second. He liked it. He doesn't like anything. So that's like the half glass, half empty. If he likes it, what are we missing? But you would feel, well, if a guy that never likes anything likes it, you got to feel good about it. Simultaneous, we closed the property the day Donald Trump got elected, more or less, and interest rates went wild. So this goes down when we got off to a bad start. 48 hours before closing, we get a call from the bank. Interest rates go up. We had a $16 million loan that was supposed to be 18. We lost $2 million or $1.5 million 48 hours before closing. So we did our due diligence. We had a great renovation budget, and we got kicked in the teeth day one. We had to audible the renovation budget immediately because we didn't have the capital for it. Now, luckily, it was in a 1031. So could we have went out and raised money? Yes, except for the fact that the 1031 component, the way you identify and decide what property you want a 1031 into, has restrictions on forward exchange, backwards exchange, construction exchanges. So we were hamstrung. Now, there are other investors in the deal, and the property was set up as a TIC. So it was challenging. All of that, everything. We looked at the budget and we said, you know what? We don't have to do this. It probably was overkill. Hindsight, it definitely would have been overkill, but would it have been overkill? If we would have done it, would we have run into the problems we ran into? And I don't know that answer, but looking back, there were just a lot of things that happened at the tail end of due diligence that I wish we would have done over, and things that we currently do now so it doesn't happen again. Unfortunately, this was a painful lesson because it was time. We lost time on, we didn't lose money. We just lost energy, effort, and trying to fix problems.
So what were some of those specific things at the end of due diligence that maybe can be tangible for people listening?
So because of the exchange and the situation, we did our due diligence. We do our due diligence immediate on contract, right? You have 30 days to do due diligence normally. So we sign contracts. We have full walk teams, full contractors, full vendors, everybody on site within 48 to 72 hours. We knocked out the due diligence in 3 days, pretty typical for that size property. We felt awesome. We didn't close for about, I think it was like 5 months. So through due diligence, there was a delay by the seller. There was a delay on our side. And we were all, we were working with the seller. There was no ill will. The ill will was on the seller's side. Through due diligence, he fired his management company basically right after we finished our due diligence. So he was managing the property himself. So through that period of time, he was sending us reports and things that were going on so we can monitor the progress, making sure we stay over 90%. This is a property that was bought in 2007, and we bought it in 2017, 2016. And through that period of time, the property never went below a 90% occupancy. And that was 2008, 2009, 2010. The occupancy never dropped below 90. It was always well collected. It was a super performing property. Through due diligence, he was not renewing tenants. He was doing his own leasing, doing his own background check. We found out when we took over, this was the first problem we made. We didn't re-verify the rent roll, re-verify the condition of the units that we walked prior to closing. It was a shame on us. But when we closed, we found on a 240 unit property, 63 tenants were put into that property through due diligence that did not meet income restrictions. They had criminal backgrounds, and there was a lot of shit that we found 3 months after we closed. And the only reason why we found this is 3 months after we close, the evictions are going through the roof. And we're looking back, we're saying, wow, how? Why? Historically, this property's never dropped below 90. And within the first 3 months, our first month of takeover, we had a great month of collections, better than anything in the last 12 months. Next month, it was a little bit less. We started to do renovations on 10 units. Okay, well, we're renovating. Occupancy is going to drop. Third month, I don't want to say the wheels were off the bus, but we lost a ton of proceeds. We had to change our business plan. And next thing you know, we go from like 1 or 2 evictions to like 12. Then month 4 comes, and our occupancy, quickly went into the 60s. So we went from a property never being below 90 to surmounting problems and criminal. There was stuff that was going on at the property that was completely crazy. The old manager was running a whorehouse out of the property where people were coming into the property expecting one thing and being like, whoa, what's going on? There was the old manager was selling drugs out of 3 units while she was there that nobody knew about because she started when the management company got fired. He brought her in, and that was the wheels came off the bus. They were occupied units paying rent, but they were not physical bodies. There were rent being paid, but she was doing her own thing. There was a guy that was murdered in his car. There was a guy that killed his family in Columbia, South Carolina, lived at our property. We just changed the branding, the sign, the whole package. The day that stuff was installed, literally the cops were in front of the property interviewing tenants that they found a murderer living at the property. This is not something, we didn't put the tenant there. it was put in prior to us, but it's like you just rebrand it. You go through some renovations. You're starting to clean it up. You know, we put a dog park in. We did the whole 9 yards. And now it's like tainted immediately. Like, you know, now that the new logo's out there and it's being put on the property, they're not calling it the old name. They're calling the property the new name on the news and in the news article. So, you know, that was the first 6 months of ownership. It's like, okay, well, we've withstood it, right? We weathered the storm. We evicted all these tenants. Let's lease it up. And it's like every time we were making progress, it's like 2 steps forward, 3 steps back. And then finally, after about 18 months, we couldn't get out of the 70s. You know, we'd hover at like the high 70s, low 80s. We looked at management and we tried everything. We tried, you know, when the tenant would file in their, you know, their credit report would come back, it would, you know, it's green, red, and yellow. So we said, okay, yellow tenants, why are they yellow? Do they owe rent to other apartment communities, or it's student debt? Student debt, let them live there, right? That's not a bad problem. And we tried things like that. We tried 2 months of security. We tried no security. We tried, you know, those different type of surety bond. We tried everything. We just couldn't get it there. So that management company out, brought a new management company in. They stepped in, and slow and steady, we climbed back up into the 90s. And then after another 18 months, we finally got into the 90s. So now it's about 3 years of ownership. We're back in the 90s. And now what's happening on our loan is that interest only is running out. So now we didn't execute our renovation plan per se. We did do a couple renovations. We did some modest renovations, but now we really haven't moved the needle on income, right? We were battling a tenant issue, finally get into the 90s. Now we're looking at it like, okay, all the money that we wanted to do to renovate, we have to spend turning and fixing and troubleshooting. So we weren't able ever to get our feet underneath us. So then what happens? We get into the 90s, we occupy it really well. Corona. So COVID comes, amortization kicks in. Now through Corona, the property performed better than it ever had, that happened to a lot of properties. Our occupancy went from 90 to 99. We were in the 90s, the high 90s throughout everything. And we said, you know what? Let's go to market. Because we didn't go to market once Corona hit. We were going to market prior, and then Corona hit, and one buyer backed out. So we took it off, got through the first part of Corona, and then we went back to market. We had an amazing buyer, came to us at our price. The price was moderate, you know, and by the way, even with the low occupancy, we did do distributions because there was actually surplus of cash. So it wasn't like the wheels are off the bus, we're losing money, we're hemorrhaging money, we're writing checks. It was actually doing distributions, be it a handful of them. It wasn't doing monthly or anything like that. We finally get to the finish line, and Corona hits, occupancy goes up. We're getting right back to where we thought we could be 4 years ago. We're just getting to that point now. And we basically looked at it and said, this deal's going to need capital. We spent our money doing things that we did not plan. We either raise more money and now do our original renovation plan, or because the market has been so strong, sell it and move on, you know, slap on the wrist. We're fine. We made some money while we owned it. We broke even on sale, and no harm, no foul. We had a really shitty 12-year loan in place, so we couldn't sell it free and clear because our interest rate today, the interest rate probably, you know, if we would have waited, we probably wouldn't have had such a big premium payable. But through the contract period, interest rates were dropping. So lo and behold, our prepayment penalty at one point was over $5 million. So we had to sell it on an assumption, which obviously discount the purchase price. And the things you learn, you know, those loans are very prohibitive. So be careful. Now we put the loan on, this goes back to the beginning. We looked at it and said, wow, interest rates are at 4. They're never going to go lower. So we felt that it'd be a really good assumption candidate in the future, because if interest rates were at 5 or 5.5 and we had a 4% loan, that's a really attractive property. It went the complete other way. So the lending was wrong from the beginning. The interest rate shot up the day of closing, or 48 hours before closing. We did a poor job staying on top of stuff after due diligence. But for the most part, it was a lot of our own capital. Now, there were investors in the deal. A handful. Total equity was like 6.5, and I think $1 million was investors and 5.5 was internal capital, my partner, and his stuff. So it was a learning lesson, not really to investors. It was a learning lesson to us. We've never made those mistakes again. And now we're targeting different loan products that we feel better about. But if you name it, we dealt with it and we learned a lot. And luckily it was one of our first acquisitions, for Toro, before Toro was like really formed, or it was just formed. I think Chris, you just started working with us. So yes, am I putting silver linings on things? No doubt. I'm not trying to say the deal was the easiest deal in the world. I'm not, I'm talking about a painful deal for me, but there were very positive things that came out of it, a learning experience, things to do, things not to do, and really go back to your roots. And, the biggest learning experience that I learned is that it takes a long time to take a property from 80 to 100% occupied. So when you're looking at new deals and you're factoring in major renovations, you can't do those deals at 97% occupancy with no problems. You start renovating and things go wrong. I'm not talking about your renovation, but tenants realize they're not going to be able to live here anymore. Delinquency adds up. Things change, which affects your underwriting. So when you go into deals, we're very, very, very aware of it. It's why we're not buying a lot of deals right now, because you're looking at a 70% occupied property and you can't get that property to 95 in your first year if you're going through major renovation. So that was a big learning experience, fact checking your due diligence, even after that 60-day period where do due diligence for 30, close in 30. If your closing starts getting pushed out, make sure you're going back to the well and checking things, and realizing that, around presidential elections, be a little understanding of what could potentially happen. It sort of happened again, which we didn't get caught with our pants down. So there was a lot to unpack there. I know I spoke about a lot of stuff, and please feel free to fire away with questions.
Yeah.
But there was a lot, and that was it was a painful deal from a standpoint of we lost 4 years on equity, which we could have put into other opportunities. But the time, energy, and effort spent on that property has set us up for such success on other properties.
Mm-hmm. Yeah, I think, one of the biggest takeaways is obviously, I think we forget, right, that this isn't just real estate we're buying. These are businesses, and your customers are basically the tenants. So, if you're going to buy an existing business, you better be sure about the revenue streams. And like you said, coming in, doing the due diligence, doing the lease audits, and checking the credit worthiness, the actuality of the tenants, and hey, can we rely on them? Do we think they're going to be able to pay consistently and, for a full year and not have problems? That's what the whole lease audit process is for. But once you start going more than 2 months, and even within 2 months, things can change, right? Because think, every single tenant for the most part is going to either renew their lease or leave within a year. So the more months you add on, the more percentage of people, their leases are going to be affected. You really got to go back and revisit that and make sure that, the information you have is not only correct, but it's also reflective of what it was when you decided to buy the property. Oftentimes too, right, as you're deciding to buy it, there's a month to, especially if it's a listed deal, there's a marketing process, there's an offering process, there's contract negotiations, that can take anywhere from, 3 to 8 weeks, depending upon the process. So you're adding months of, even if it's under contract for 60 days, you're still analyzing the deal when you first get it, weeks prior to, and then you get into the closing process and things slightly change. And the more you add on to it, the more it changes. So I think that itself is going to be huge for people, of just understanding, like, it's not, and I think this goes back to underwriting too, in general, right? It's not, hey, you create a model in, the first day you analyze it and it stays exactly the same for the 5 years you own a deal. You're constantly updating it. You're constantly changing it. I think it's the same thing, like understanding those revenue streams, which is, the tenants or the people paying the applicant, all the different fees that come with it, constantly analyzing it and making sure that it's up to the standards that they were or that you find acceptable.
I think that the other thing there, because, one thing that we've learned, this process and throughout, I'm not typically putting occupancy clauses in my contracts, right? You see a lot of contracts that say maintain 90% occupancy. I'd rather take a property over at 80% with no problems than 94% with the worst tenants in the world. So, that's something that I never push back on contracts. We might put it on a first draft, but if they take it out, I'll just go back with don't lease it, keep it vacant. Especially people know we buy deals and we renovate. So if I take over a property with 20% vacancy, I can renovate quicker. The faster I renovate, the faster I can change the tenant base, the faster the property works. But that's not everybody's business model. But keep in mind that when you put that occupancy clause in there, they're supposed to hold up their end of the bargain, that they're going to lease it the way they always have. That's a hard lawsuit to prove they didn't do what they originally did, right? Mm-hmm. So you spend money fighting that you might never recoup. So Chris is 100% right, where these deals go to market and they spend time going through that. Here's a tip, right? When you go to sell something, and I'm not saying we do it, we actually don't. When we sold one of our properties, we told manager, I don't think this buyer is real. So manage this as if we still own it. But what sellers do a lot of the times is once they go to sell, they scale back, right? They cut their advertising. They, maybe they don't have a full on-site manager anymore. They're only there 4 days a week. So they start cutting things. So it generates very profitable returns through this process. So you just got to keep an eye on that. So maybe expenses dropped a little bit. People might look at that and say, that's great, right? Expenses are down. That doesn't mean they're going to operate like that. And then, they may be working out deals with tenants to keep payments good and income going up. So you just got to be very aware through that first day the deal goes to market to when you buy it. Keep in mind that I don't wake up one morning and say, I'm selling today. You prepare for sale, right? You do things for sale. Now, maybe I'm shooting myself in the foot because now buyers look at our properties are going to start questioning things. But at the end of the day, we're probably not selling in the near future, so I don't give a fuck. But the other side of it is when you're buying a deal, keep in mind that, this is probably a 2 or 3 month process that went into this to get it ready. So it's going to look the best it possibly can from a financial perspective. So you just got to understand that as you're going through this process, because through that 3 to 8 weeks or even longer or potentially shorter, these are not, you're not day trading commercial real estate, right? It's a time process. And like anything else, a problem today probably doesn't rear its head today or even tomorrow. It's probably 2 or 3 months down the road when that might pop up. So just be, you just got to be a little bit cautious. I'm not trying to scare anybody away, but these are things that we've learned and we're educated and we're not making those mistakes again. So I want someone to take that education and realize it. So if the mistakes happen, you know how to correct them, and then vice versa. Hopefully the mistakes never happen.
No, 100%. I think that occupancy clause is good because I know when I was buying the 16 unit, we had in, just like you said, first draft, because we're using the same attorney, it was like a 90% economic. They dropped it to 80 and I said, just throw it in at 85. But if they had dropped to 80, I was never going to sue them for the 5% delta over 60 days. But for me, it was always like, okay, I don't want them to just totally take their foot off the pedal. I want them to at least go in there. And, a lot of times in closing, if you have a good buyer and seller and you communicate what you're looking for, right? If you come in and say, hey, and you say, look, I would rather you leave a unit vacant for me, because we're closing in 30 days, then put in some shitty tenant that I may not be able to do, or, hey, I'd rather you just get them out instead of trying to work with them. Like, you may be able to work some of those things out through closing. It's not always a hard line thing, especially if you kind of talk through it. So, but again, it comes back to what you're looking to do, right? If you've got a brand new built building and everything's at market, well, yeah, then you don't want occupancy falling below 90% or 95%, whatever. I would imagine 95 is going to be tough to get in a contract, but you may not want, and you may care more about that, right? So I think it comes back to knowing what you want. And then also, as you negotiate a contract, just kind of picking and choosing your battles as well. Is there anything, like you talked about, the capital, with the loan getting messed up, the proceeds, having to put money into things you didn't know about. Is there another, like specific things that you now implement as you're underwriting or going through due diligence that deal specifically taught you or made you look at things differently that you think has either helped you on other properties or, you've discovered on other properties or just is now standard practice for you guys?
Definitely just re-verifying all incoming tenants through the contract period. It's just, making sure you're aware of what's going on at the property. From an underwriting perspective, realizing it takes a lot longer to lease a property up than you may project. That's probably the biggest lesson learned that, the submarket, the other thing that we ran into, there was no new construction and then all of a sudden there was just new construction all over the place. So that was another issue that we ran in. I remember the submarket report had like no new deliveries in the last 25 years. We bought the property and like, bang, they broke ground on like 4 properties. Like one was across the street. So you're like, realizing that the landscape can change quickly. So it's just understanding that stuff when you're looking at a deal and going through the offer process. So realizing that if you buy a property that's 80% and you have a year one occupancy at 96, that means if you buy it at 80, if you close that year at 100, just quick math, 80 and 190, you're only 90% for the first year. So if you have a first year underwriting at 93, you're going to be wrong. So just keeping in mind that lease ups take a little bit longer. And typically when you're leasing a property up, you don't get your pro forma rents immediately, because if you're changing the demographics of a property, that means the people living there probably can't afford or won't afford to pay, or you probably don't want them to pay the new rent. So you might have a first generation lease. You spend $5,000 a door. You might have a first general, instead of getting 1,000, you might get 900. So maybe instead of going in, you say, okay, we're going to raise the rents 100 here. We're not going to do everything. We're going to do appliances and flooring. And then that second generation, you come in with granite and a backsplash or whatever it may be. But you have to understand that when you're looking at it, that yes, you want to go in guns blazing, but you got to change the property's view, appeal, vision first, and then go into your interior. So I didn't learn exterior in from this property because we always did that. But you got to understand that it takes some time to get your feet underneath you. Now, yes, we buy properties where we think we're going to get 900 and we get 950 on our pro forma rents. But understand that if you're taking a property from 400 to 800, you probably got a lull that's going to take a little bit of time. And that's the biggest learning lesson I got there. And we didn't go in with a plan to do that. We were just dealt those cards. And now we take that into underwriting, knowing that, you can't take a $400 average rent to 800 on your first generation of leases. You probably got to tier it in or vacate the property to 50% and then renovate, right? You can't have your cake and eat it too. And I think that's the biggest lesson we learned.
Yeah. The exterior interior thing is huge. And also that you broke down that first year pro forma, the 12 months, not even just on the occupancy side, even on the average rent side, because let's say you think you can push rent $100. Well, that's if you started pushing it day one and you got to $100 by month 12, you're only going to average 50 for the year. And I think you and I would both agree, it's very rarely you step in day one and you just start implementing a plan, right? A lot of times you're bringing in new property management team, new property managers, you're figuring out systems. Like that stuff takes some time to get implemented, and you're not going from 800 to 900 day one. Maybe you're going from 800 to 850 or 875. So you may not even hit that 100 in the first, by month 12 to get you that $50, right? If you wanted to get that $100 in the first year, you would have to be either getting the $100 day one, or you would have to average over it by month 12. Like you said, if it was a linear progression, you'd have to hit 200. If it's compounding, it could be a little bit less just because, early months, but definitely look, especially in the first year, look at it on a monthly basis, because you'll be pretty shocked at how much slower things move in the first year versus the second year, right? Because let's say you could push $200 and you said, okay, I'm going to do 100 in the first year, 100 in the second year. Well, your average rent is going to be up $50 for the first year, but it's going to be up $150 for the second year. Mm-hmm. So you're actually going to jump, instead of 100 and 100, you're going to jump 50 and then another 100. So, and then your year 3, you would jump up another 50. So, you have to just understand how that works. But the exterior in is interesting too, because right now in the 16 unit we bought, our exterior stuff has been delayed, and I'm in the process of renovating 4 units. And what I'm thinking about doing is advertising it with like 3 months of concessions. So basically saying like, hey, do like a rendering of like, hey, we're putting in this laundry facility, we're painting, we're doing this landscaping, we're doing all this stuff for the pool and the fence. Some of the work's going to be getting done over the next 2 to 4 weeks as we finish the renovations and lease up, but not everything's going to be done. So like for me, it's going to be like, okay, look, here's what it's going to look like. Here's what the rent's going to be. Sign a lease. I'll give you $100-$150 off a month for the next 3 months until it's done. And then you have the benefits at the full rent type of thing where it's like, that way. So I'm not going the full 12 months at a $50, $100, $150 delta against me. I can kind of give some people a little bit of leeway as the stuff gets done and hopefully, finish it up through then. So I don't know if that's going to be the answer, if that's going to work, but that's just kind of my thought process right now as I'm going through it. Because you do recognize it's like, okay, if you have the full rent for all these things, well, why would somebody pay full rent when it's not fully completed? So, and also too, the other part, the more you increase the rent, the more the tenant profile is going to change and just the more overall feeling you're going to get when you're on the property. So sometimes too, it's not even like, hey, we do the pool, the dog park, the fitness center. Sometimes just like, the feeling of the property just takes some time to change. So even if you're $300 below the property next door, which has already completed it, well, you may have to, take a year or two to really change the feeling and the tenant profile to be equivalent to that and just that it's on it. So sometimes it's not always just like hey, we finished all our exterior work, now we get $300. Sometimes there is that, that ladder that you have to climb up. You can't just skip rungs.
Yep. I think the other thing, one thing interesting and spitballing a little bit, on those concession months, maybe if you get those tenants to get like a 15-month lease or a 14-month lease, you can burn those concessions off quicker. And at least you have them there cycling into over a year. So you don't have that potential turn cost that might come up where you gave some concessions. But simultaneously behind that is that you're right. These things are fluid. It's not cut and dry, black and white. So, your stuff gets delayed. You can't just not do anything, right? But the other thing to keep in mind there is that when you take over a property, you got to remember, you don't just pause leasing. You might take over a property and a tenant comes in 2 days later and signs a lease. If you're expecting on a 16 unit or on a 500 unit, if you're expecting to turn a certain amount of tenants and you just signed the tenant to a 12-month lease 2 days after takeover, that unit cannot change rents until their lease expires or you evict them for some reason. So you got to be aware of the leasing schedule and when your leases expire. Because I think a lot of people discount that and they say, 100 units, I'm gonna do 50 in year 1 and 50 in year 2. Well, if it takes you 2 months or 3 months to kick that off and you sign 10 leases, you only can turn 90% of the units year 1. So you might be off just on the pure calendar. So, those are things that you learn and you go through. Do I think that you should put a hold, cold, hard, I can't do this deal if it doesn't check off? No. Once again, remember Chris said earlier, understand where your income's coming from and understand those streams of revenue, and you can better assess the 12-month picture. But, like anything else, if you renovate less units at a higher rent, you get to the same place at renovating more units at a lower rent. So you got to remember there are levers that you're pulling throughout ownership to tweak business plan, get back on track, exceed expectations. You might realize it only cost you $3,000 to get the premium you thought that you had to spend 10. So there are things that will change throughout, but understanding what those are and how you can pull those levers, like Chris said, maybe it's a concession because you don't have the new laundry room or stuff like that, but just understanding that as you go in will make you better at assessing. Then, you don't want to be reactive. You will always be reactive, but you want to try and get out in front of as many of these issues as you possibly can. It typically leads to more success. Switching gears to Chris, when that deal that you just bought, your 24 unit, came in, knowing everything that you know and been doing this for as long as you have, what things did you foresee being issues and how did you get out in front of potential issues on a tight closing? And what did you see that you said, I'm doing this. How do I get out in front of it? Go.
Yeah. So I guess just to give some people a little bit of context. So this was, I got sent 6 quads about 15 minutes away from the 16 unit that I bought, with like 3 weeks to close, and it had to be all cash, and got it it was a wholesale. It was actually a double wholesale deal. But got it sent to me from somebody I'd already known who I'd met here. And he passed on and said, "Hey, I thought this was right up your alley. I just fired my internal property manager because she was stealing from me, basically, so I can't do it. Here you go," type of thing. And I owe him a bottle of wine or a bottle of liquor or something. So, but yeah, for me, it was, luckily having done a bunch of deals in that area, having owned, I already knew kind of like what the rental market was and like what things needed to be to make sense. So like when it came in, the pricing was right around, it was at 80 a door, give or take. And rents were currently at 715, with the unit sizes being about 980 square feet. I knew rents should be at least 950, if not well over $1,000, depending upon renovation scale and location. So I already knew there was a large delta in what the rents were and what they could be. And just based on pricing and, the way stuff is sold, I knew kind of high level that it all made sense. But for me, it was really, again, digging in and understanding like who all the people were involved in the deal, who were the sellers, what exactly I was getting myself in for, where was the money going, what deals was I purchasing, what condition were they in, and, really trying to understand the backstory of everything. And luckily, all the people involved are really, really great people. And it was 21 buildings that this one couple had owned since they were built in the 80s. And this group was buying 15 and they were looking to offload the other 6. They sent the 6 to this other guy who decided he didn't want to buy them, so sent it to me. And, they each made a fee and a kicker, which is great for them. But it was, if I didn't like all the people involved, I would have never done the deal, because there was so much back and forth. Like I didn't have a fully executed contract until the week before closing. Now I only had $6,000 on the line because that's, what I said that was all I was willing to do. But it was just kind of understanding all the mechanics behind it that, really made it possible. The other nice thing too is I'd pulled a list from the county for all the 2 to 9 unit properties and 10 plus unit properties in the area. And I had already identified all these buildings as possible deals to start picking the phone up and calling. So when it came to me, I had already done some research on the area. I'd done some research on the properties. I had actually looked up the names of the owners for these buildings because it was an LLC, because I saw they had owned them for 30 something years. I was like, okay, this is, probably somebody you want to get in touch with and see if they'd be willing to sell. So I'd already done some of the preliminary research on it. So when it kind of came up, I was like, this is just kind of, right place, right time. And, a lot of it made sense.
Yeah, no, I think that's important for anyone listening. Obviously these transactions happen. They happen quickly. They happen over time. But understanding the mechanics behind any of them, especially in a situation like that, we bought a deal. Chris knows that, one of our properties in Jacksonville, it was a wholesale. We bought a couple of wholesale larger properties, but knowing the parties involved and the mechanics behind it are super important, because you don't want to be caught with your pants down in a shitty situation where you have money on the line. You have to fire at all cylinders, and understanding that is important, because you're going to get out in front of any hiccups or wait a second, where'd this money go? And where that, why is this person making money? How are they involved? So when you understand that, you can build and paint that picture that, okay, here's the opportunity, right? There's some money to be made here. This hasn't even hit the market, right? Or whatever it is. And also in your target market, understanding your demographics, understanding the location, whether you're single family flipping or buying multifamily, if you know what you're looking for and where you're looking for it, when that opportunity comes along, you can react a lot quicker than when someone sends you a random deal in a random market that you're not familiar with. So Chris, obviously understanding the market, owning in the market, the knowledge of the market, and already having these properties identified in his system, and he just, someone beat him to it as far as bringing it to his table. He was well aware. So he was well ready to execute. And that's why you're able to execute in 3 weeks. It's not because you have, $5 million in your bank account that you can just close on tomorrow. It's not that you have a good lawyer or a good accountant. That stuff helps, but the knowledge behind the deal is super important. So I think anyone listening has to understand that knowing where you want to invest is important.
Yeah.
Then understanding the submarkets within the area you want to invest is important, because if a good deal comes across your desk, you know it. And you could do all the underwriting in the world and you could do all the marketing, you do everything you want. But there's a piece of real estate. We say it all the time. I say it on here all the time. There's a feel component that you get, whether the transaction seems off or if it's not 100%, in good graces. That feeling goes a long way to taking the deal A to Z.
Mm-hmm. Yeah, I think one of the two biggest things for me that made me feel comfortable enough to pull the trigger. And I'm still nervous today that I've fucked up. We just closed on Friday. Today's Tuesday. So it's been 3-4 days of ownership. The biggest things were the guy that contacted me, we spoke a bunch. Then we got on a conference call with the other people that were buying the other buildings, and they were amazing people, super upfront and honest. I got no ill will or anything from them. They were super happy that I was coming into the deal. And then not only that, they were also more than willing to put me in touch with the current owner and the woman selling them. And the people that were buying the other buildings had owned one of the other buildings, had owned a building for like 4 years. So they had been in this area and in these properties for 4 years. They had known the seller for 4 years, and they were willing to let me meet them. Being able to get that comfort level of like meeting all the parties, being brought in, there was no like closed doors or like, hey, you're either buying it or you're not, or you can't know who the other parties are. Like all of that made me feel incredibly comfortable, and also it felt like there was no, backdoor things or people getting scammed. And yeah, I had attorneys look over the contracts. I made sure to look over all the contracts beforehand, spoke with the closing attorney, had a bunch of people review it, verified the owners were the actual owners, even though I'd actually done it. The title and survey, all that stuff was gotten together. So it wasn't like I just gave people money, right? I didn't just send a wire and say, oh, I'll take my property now. I did all the background, or at least a lot of the background necessary, but that component was super important. Like if they had said like, hey, if this guy had come to me and said, hey, I've got these deals, you can buy them. And I said, well, what's going on? He said, look, you're going through me and you're buying them or not. I would have told him to go fuck himself. I would have said, there's no shot, right? I'm not doing that, because even with all that information, there was still a few days where I was like, I'm not doing this deal. Like, this is ridiculous. I'll pay this. I'll lose this $6,000. I'll get over it, because I put up $100,000 deposit with 6 being non-refundable. That was to cover some appraisals, because they were going to close with or without me, but they would have had to do a hard money loan. They needed an appraisal. So I was going to pay that regardless. But like that made it hugely comfortable for me. The other factor that made it super interesting for me was I knew that I'm ultra confident that we're going to be able to get $1,000 plus in rent. We'll probably have to spend a little bit of money to do it. We may not, because there's actually there's been 2 units on the market at other buildings for $1,000 with basically no work done, which makes me super excited. But I knew there was a good shot we'd get $1,000. And when I did like the high level underwriting, that made the per unit value around $125,000, $130,000 per unit, because they operate so cheap, because all the utilities are in the tenant's name, which is awesome. So for me, I said, okay, one of the worst case scenarios is if I have to bring these buildings to the studs and redo everything, right? New plumbing, new electrical, new windows, new doors, new drywall, new ACs, new roofs. Like that's probably going to cost me $50,000 a unit, give or take. Maybe it's 55, maybe it's 60, maybe it's 40, probably in and around that range. That's going to put me very close to break even. Like if for some reason I had to do all of that, okay, if I really think it's worth $130,000 a unit and I have to spend 50 because I have no idea what I'm doing, well, I should break even, right? 80 plus 50 is 130, or damn near close. I'm not losing my shirt. Do I think that's going to happen? No, because a lot of the ACs are done well. The place was in really good condition. The roofs are a little bit old, but a lot of this stuff has been done and they've been very well maintained. So yeah, maybe I have a budget of $7,000 per unit and it ends up being $15,000 per unit. That's very possible. I'm walking in knowing that, because even though I walked every unit, I had inspection reports day one. Even though I did all that, I recognize there's things I could have missed because it was a short due diligence. I'm very confident that we're still going to at least make some money on this deal, if not what I think we're going to make, because of that factor that I know it's probably not going to need all new windows. It's probably not going to need all new electrical and plumbing. It's probably not going to need, all new drywall, so that removes a lot of those potential costs that could kind of come in. So those two things, besides, just having an understanding of the market, the underwriting and all that stuff, really gave me a lot of comfort going into it and being able to pull the trigger so quickly.
Yep. And I think that was you hit the nail on the head. Just understanding the downside is just as important as looking at the rose-colored glasses upside, right? We just looked at a deal that was a disaster, and then it could be the best deal I've seen in a long time, but the potential upside was far and away outweighed. I mean, the downside was significantly more outweighed, that the amount of disaster that could go wrong outweighed the potential of it being the best deal ever. And the risk wasn't worth the reward. And understanding that if that downside does take place, what's your fail safe? And as like Chris said, you're back into the per door value. A lot can go wrong and still break even. And then time heals all wounds almost mentality is that if you own it for 20 years or 10 years or 5 years or 7 years, even if everything goes wrong, you have a far superior product for the long haul. Mm-hmm. So you have all those factors where, you put that on a spreadsheet and the pros and cons or a piece of paper, and the pros outweigh the cons every day of the week, which is why you're able to, push forward quickly.
Mm-hmm. Yeah. And I know obviously when I was talking about that stuff, if you have major issues like foundational or structural or environmental, that can play into it. But, the fact that there was a full inspection and they didn't see any issues across any of the buildings in that regard, I didn't see anything, the likelihood of that happening, I think, is very, very minimal, where, it is possible that I could be wrong about the plumbing. That's way more likely than me missing a full, me and an inspector and an appraiser all missing, foundational issues across all 6 properties, let alone all 21, even though I didn't buy them. I think that's such a minimal risk. Whereas I understand that, maybe the plumbing is shot and I didn't catch leaks, and maybe the water damage isn't showing yet. And it does need all new repipes for the, supply lines and the waste lines. That would suck, right? Didn't budget for it. Don't expect to need it. I'll probably need plumbing repairs on an ongoing basis just because they're 40-year-old buildings, 35-year-old buildings. But I didn't budget for a full repipe, but there is a likelihood or a possibility that it could happen, right? Because I didn't scope the lines, didn't have a plumber come check it out, just had a general inspector come do it. Do I think it's likely? No, because they do a really good job of maintaining it. I was able to talk to the maintenance guy, the on-site manager, all that stuff. But, it is a risk involved. But yeah, I think, those are just the things you have to look at. I think, when you're looking at a deal and you're buying it for $95 a door and you think it's worth, $120, there's nothing wrong with that. But, like we, saw in John's thing, there's a lot of things that can go wrong very quickly that can kind of impact that stuff. And that's, for me, it's okay, even if for some reason I can't rent it, there's still, the nice thing too is they're quad buildings or residential buildings. So technically you could even just sell them off individually, which also gives me multiple exit strategies as well. I can actually technically sell them off as individual units if I really wanted to. I don't think I want to do that. I don't want to sell 24 individual units in a few years. I think that would just be not worth my time. But, you could always go, hey, maybe they're not worth 130 a door as a portfolio, but, maybe you sell them off to house hacking investors for 125 a door and you get close to what you thought, right? Not that I'm saying I want to sell overpriced stuff to investors, but people look at things different ways, right? Me buying 24 units versus me buying my own personal house hack, I'm going to value those two things totally different, right? I will personally pay more. If I'm going to house hack a 4-unit, I'll pay more for something nicer. I don't care about that, right? Because I'm going to look at it differently than if I'm buying it just as a totally passive investment. So, also having those different potential exit strategies, I think, gave me some reassurance as well. But I'm already getting things slightly wrong. The loan I thought we were going to get isn't going to quite be what we're going to get, right? Because we closed in cash. We're not going to stay in cash. We're going to do a refinance. I have several options. They're not far off what I thought, but they're not quite what I was expecting. So, it kind of is what it is too, right? I'm going to make mistakes. I'm going to get things wrong, but you just kind of adjust and make do.
Yes. I think that's the big thing of realizing that you're not going to be perfect. Your underwriting is not going to be perfect. You're going to be off in one area or the other, but understanding that, things will change. Just be prepared to make the changes when needed to course correct or fix or get back on track, however you want to look at it. But understanding all those components is what makes the deal successful. It's not, I just bought the best deal in the world and I'm not going to have any headaches and this thing's going to crush it, right? That typically doesn't happen, right? There are things that go wrong and right throughout the whole process. You just want to be aware of them. And if you know what they are, you're more educated than if you go in blind.
Mm-hmm. No, for sure. I mean, we were talking about the 2 deals we had bought in Jacksonville that we just bought at amazing prices. They haven't gone overwhelmingly well, but they've gone decent enough. But we just bought them so well that those little changes aren't necessarily going to kill us, and they're not going to be a big deal at the end of the day. So I think understanding, what your downside is, or what wiggle room you have, is super important as well.
Yep, 100%.
Cool. As we kind of wrap up, you got any last thoughts, questions, comments, things you want to touch on?
I think that those were 2 good examples of anyone can listen to and pick what you like and pick what you don't like and just implement it going forward. But no, I think those are 2 good deals to break down from a successful acquisition to a struggling deal, but well taught. So I think understanding that is important for new investors, experienced investors, new operators, experienced operators, whole 9 yards. It's 2 ways to skin a cat.
Mm-hmm. Yeah, I think one thing I want to throw in, I think you said it actually, was the more things that have to go right in a deal, the riskier it gets, right? The more things you have to say, well, if this happens and if this happens, right? If you write out a list and say, all right, what has to go right for this deal just to work? And if you've got a really long list, you've got to recognize that there's a problem there, right? For me, it was, I just got to, hit the rents that they're getting out in the market and it'll more than work. I don't even have to come close to what, to get, even if I got 800, 900, 950, deal still works and performs very well. So for me, it wasn't like I've got to come in and do all this crazy stuff, to make 8%, so I think I'm pretty sure you said it on an episode before. So just as you're looking at deals, try to poke holes in it, but then also look at, all right, what has to go right for this deal to work?
So I think that is probably one of the smartest things said here, right? Not because I said it and it or not, but
it's the smartest thing because you're quoting me. Exactly.
Exactly. You're quoting me, so you're a genius, right? No, it goes back to the, it goes back to, I want to make 30%. I want to make 30%. I want to make 30%, right? If you have to go through a drill sergeant boot camp and everything has to go right to hit that return, you have to ask yourself, is it worth it, right? So the first part of that is ask yourself what has to go right to get there, and then ask yourself what has to go wrong and what happens if you miss. And it's the risk reward, right? Everyone likes to make a lot of money on their investments, but there's something to be said about the peace of mind behind the investment. And if you have your list and you need, if you need everything to go right, are you buying it at the right price, right? It's all risk reward. And is the risk worth all of these things having to go right? And the answer could be yes. I'm not trying to deter people from what has to go right to buy the deal, but if everything has to go right, what are you getting out of that? That's the question that supersedes what goes right, what goes wrong. It's what do I want to get out of this investment? Then ask yourself the questions. Because if the answer is you want a solid return of 5 to 8%, and your list is ridiculously long, ask yourself, should I do this? If you want to get 5 to 8 and the list is all I got to do is achieve 20% of what I think I can achieve, well, then you're having a totally different conversation. So just knowing that is important because there's a lot that has to go right for deals to work, but there's also a lot that doesn't have to go right for deals to work. You just got to understand the difference, and that's the most important thing.
100%. I think that's a great place to wrap up. I think you broke it down and expanded on it really well. But thank you guys so much for listening to this episode of the podcast. If you are not already subscribed, it would mean the world to us if you would do so. And if you are, please send it to someone that would get a tremendous amount of value. And if you guys like this episode, please reach out to John and I. If you have our cell phones or emails, hit us up on Instagram. Shout out to Steve McAdoo for hitting me up for the last time we did this, saying he enjoyed it. So we do appreciate it when people reach out. Maybe I'll give you a little shout out to earlier on in the next episode if you do. So if you do like this stuff, please reach out. There's not a ton of feedback that we get on this. It's just the two of us talking to each other for, God, I don't know, was this 45, 60 minutes? And, I guess people listen, but who really knows? So feel free to hit us up. Let us know if you like it. And if you have any ideas, suggestions, questions, definitely let us know. And, maybe we'll cover it in a future episode.